Well, welcome everybody. Just a quick blessing on this time, Lord. Thank you for this time. Give us wisdom and direction as we talk through some of these wonderful concepts around estate planning and safeguarding assets and planning. It is many are the plans of a man's heart, Lord, but you direct our steps, and we just pray for that now. In your name we pray. Amen. Great. So I got a thumbs up. Yep, we're good. Thank you so much. All right. So with that, I've got a little slide deck here that's going to, I think, sort of be able to direct our conversation. So hopefully everybody is seeing that. And then if you, from a video perspective, I'm here. And then if you look at, I think Gina Seal's login down below, you'll see Ann Waters, who is joining me. She just gave you a wave there. And Mr. Don Coomer. And so this, along with me sort of getting to play in this space, you are looking at just two of the most amazing estate planning, trust administration, many years of collective experience between the two of them, and background in law work. I went to Notre Dame for undergraduate and Vanderbilt for her law degree with a focus in tax over these years as a CPA as well. And Mr. Coomer has a library of credentials. It's just an amazing experience. Over 50 years in the profession with a special focus in estates and trusts. We are so blessed to have just amazing team members with us today. Thank you.
Glad to be here.
It's really great. So, well, with that, I want to just kind of, so Circular 230, we're always required to disclose this. Please, actually discuss your specific situation with your CPA always. So our agenda, I didn't realize that we had that process for our click-throughs here. Just to talk a little bit today about our current state, kind of where we stand right now from an estate planning perspective, and then also to look at where we've been historically, because today is a little bit of a golden age, I think, for estate planning, and we'll get into that. We're also going to talk about some of the updates from the Secure and CARES Act implications and the normal strategies that we've been employing really for a long time. And then we're going to layer on top of some of those normal strategies what the Biden plan is around both a little bit of income tax, but especially estate and gift tax, which is a really big deal. And we'll bring a little bit of color around those conversations, around likelihood, et cetera. And then in light of the Biden plan, we're going to talk about a couple of planning considerations to layer on top of sort of these normal strategies that we've talked through historically. And so I may even kind of position myself a little bit here. So as I look at Ann and Mr. Coomer, who are across the table from me, I won't be staring off into space every time. And so our current state, we have a unified exemption right now between gift and estate tax, and it is a big number. All right, right now, it's 11.58 million is the amount of assets that we can pass estate tax free per person. So you've got to double that if you're a married couple. That is a lot of money. We're talking about 23 and growing. Just a lot of money that we can pass estate tax free, and it is more than we've ever had in history, right, guys?
Yes, and in fact, one good thing about this, and not to jump ahead of where you are, but you said jointly, and it was not always that way. It's only been that way for recent years. And prior to the portability of where we could use the joint numbers, we had to do some awfully sophisticated and sometimes complex tax planning. Didn't mean to interrupt you, but
no, not at all. That's exactly right, Mr. Coomer. Portability, which we're going to mention here in a little bit, has changed the whole world. We used to have to do what we call A/B trust planning, right? Right. And so, Ann, we have all these documents, and I'll bet you we've got a lot of clients right now that have A/B.
One of the things we're really recommending people do first, probably before anything after you leave this meeting, is go back and read your documents, because they may do things that you did not understand they were going to do. We're going to talk about that a little bit more today, but the starting point is, where are you today? Because we know where the tax law is today, but where your documents, depending on when they were drafted, may say something different than what you anticipated, and may work differently than the plan, your plan, especially if you're married.
That's exactly right.
Yep.
And one of those things that we used to plan for and still do is generation skipping tax, right, Ann? So we'll find that in documents as well, and planning, particularly around gifting with GSC. Can you talk at just a really high level, as we kind of talk about this current state and give some baselines here for our future conversations? What in the world is GST, Ann?
Yeah, so that's, the original intent was, some smart people way back in the day when we were at 600,000, 750, $1 million, were trying to build in, to craft in plans where we could have these dynasty giving plans long term, and their idea was, well, my kids are taken care of, I'm going to skip to my grandchildren or my great grandchildren. And so the generation skipping tax, transfer tax, is a tax that came in that was an additional tax on top of the estate tax. So potentially, back in the day, if you stepped into this trap and didn't realize it, you could effectively 100% of your estate could go in taxes at your death.
Yep. Which is terrible.
Which is terrible.
Which is terrible. And so also in the current state, and this has become a really, with these large exemptions that we just referenced, over $11 million and growing, we have been doing a lot of planning around step-up in basis. Mr. Coomer, can you talk to us about the step-up in basis concept?
Yes, indeed. Step-up in basis, I'm not sure we realize just what a great piece of tax law that is. As it turns out, with this $11,580,000 of lifetime exclusion or exemption, any property passing through that estate to a beneficiary gets a basis stepped up in that asset to its current market value. Now, what does that mean? It means that if that asset has, for example, $100,000 worth of cost in the hands of the decedent and is worth $200,000 at the time it passes to the beneficiary or survivor, and that asset is then sold for the $200,000, there is no tax paid on that asset. Now, the step-up in basis is something that we want to see stay in this tax law, something we really need to fight for. And if that were to go away, twice in our history that I am aware of, we have done away, or Congress has had the wisdom to do away with the step-up in basis provision. And what we had then was what was called carryover basis. Mm-hmm. At the death of the decedent, the asset passing to the survivor or beneficiary carried the same basis as in the hands of the decedent, which means that when that asset was sold, it was subject to tax. In 1976, we did away with step-up basis and had carryover basis, and it was a disaster. I can recall having filed one estate tax return 3 times as the rules were changed to try to account for the problems that were not anticipated by doing away with step-up in basis. We tried it again in 2010. We now have step-up in basis again. Without step-up in basis, it is awfully complicated. Mm-hmm. So what we want is keep that step-up in basis. Let's raise that asset up to its fair market value so that the beneficiary takes it at what its value is the date it's gotten received.
It's just the administrative nightmare of trying to carry over historical basis, track basis. There are assets that sometimes have been bounced around, 1031 exchanges. I mean, there's just a long list of issues.
Family farms. I mean, we don't even have to go far, really back very far to see how many people have no idea what their grandparents paid for the family farm.
Yeah, and some of that property's been in families for generations, just handed down. So what is the carryover basis?
And now let's talk about, I don't even know if we want to get into this, but all this partnership, outside basis, those kind of accounting nightmares that we personally inside the firm have experienced a lot of this year. Trying to track carryover, it's kind of like we all got this clean slate. And for some of my clients, especially if the children are going back and trying to go through the parents' records, it was just kind of grace. It was like everything's absolved and we get to start over, and it gave us an easy way to move forward for children, grandchildren that are now going to have to try to go back and find these historical records, which I believe is probably why it didn't get passed the last time in a previous administration was trying to get it through. And I think that ultimately it wasn't even necessarily a tax issue. It was more of a record-keeping,
It's an accounting,
administrative
yeah,
issue.
it is.
That's right. That's
In
right.
fact, the interesting one, what you say is so true, because in '76, when we had the carryover basis, no benefit of step up, retroactively, Congress did away with it back to day one. So we went back and did the basis step up, even on the returns where we tried to attempt a carryover basis. The complexity there, the cost of that is awful.
Astronomical.
Astronomical.
And it's back on the table, guys. You know,
Back
we're going to
on
talk
the table.
about this around the
Right
Biden
on.
plan in a little bit. This step up in basis, one of the many matters that are at hand around the Biden tax plan, which we'll talk about in just a little bit. So I'm going to go kind of fast through this rest of this current state, because I really do want to try and, we have an hour, we're going to honor our time together. There's a lot of established strategies right now, right, guys? We've got CRATs, we have GRATs, we have all sorts of gifting, we have estate freeze matters. Right now, there has been just decades of litigation and court cases, and we know the rules right now, which is a nice place to be in. And as you spoke about earlier, Mr. Coomer, when the rules change, all of a sudden, everything goes up in the air.
It does.
It's like trying to play a football game without having the number of downs, or how many yards to get the first down. You know, football season's back up. We're all really excited about that. And so I'll try and keep the sports metaphors to a minimum. But I mean, imagine not having any referees, right? And no understanding of a rule book. And unfortunately, when you have great, big, exhaustive changes, that's what transpires. And so right now, we know the playing field. We have established strategies around trust work, estate work, as we mentioned, different gifting strategies. They're all very understood, which incorporates both the AFRs and the 75/20 rates, which is another interesting thing about the current state. And I'm going to just bounce forward to this next slide so you can kind of see some perspective on this. We have the lowest, and what these rates do, let's kind of round table this for a moment. The 75/20 rate and the applicable federal rates are required interest rates that you either use for calculations around trust or for notes between related parties in order to maintain substantial economic effect. So right now, Mr. Coomer, this 75/20 rate, it's amazing. And what do we use that for?
Well, my first thought on that, if one were doing granted retained annuity trust, one can use a very low rate so that the annuity rate that is being paid to the grantor is low, which means if there's growth in that asset, there is greater growth to pass on to that next generation without being included in the estate tax. That's my first thought on it.
And especially when we're talking about this 120% of the applicable federal midterm rate, 0.46 right now. Just at the beginning of this year, it's 2%, which is to say if you put $1 million in a GRAT, that is the percentage of payout that has to come back each year. And so just amazing rates. And then also you can see here on, and this is just the most recent for September, the AFR rate schedules. But I mean, I remember, I've got a ton of notes historically that have been out there at 4, 5, 6%.
Absolutely.
And so this is also a good time to try and maybe refinance old AFR related notes. You have to give additional consideration. It needs to pass the arm's length concept, but it's a good time to revisit some of the old planning as well.
Exactly.
So just to talk through again, the GRATs, charitable remainder trust, et cetera, the point is, or we really want to lead trust in this case, right? So the point is when you're using the AFR is the delta between what the trust is earning versus the amount that's getting paid out to the current income beneficiary continues to be accumulated inside the trust. So once it goes at the end of whatever the term is that you defined, the remainder amount sitting in the trust was all calculated as if it was going to grow at whatever the rate is that we defined, but the built-in internal calculations is using our AFR rate. So obviously the point is what we're being able to leave to our remainder beneficiaries, assuming that it was growing at a reasonable rate in today's market, then we've left a much bigger amount, but we only had to use up a portion of our exemption on the date of the gift based upon these much lower rates. So it's a formula, the calculation that the Treasury's given us to use, and therefore we're being able to gift more than the exemption amount we're having to use up.
Yep. the lower the rate, the more that we are able to pass to the
Exactly.
next generation estate tax free.
Exactly.
And so with these extremely low rates, we're in almost a golden age for some of this advanced planning that we integrate with a lot of our high net worth clients, especially those that already have taxable estates. So also low estate and gift tax rates right now. We're talking about a 40% gift or estate tax and or gift, right? They're unified like we talked about. This is historically speaking, very low.
It is. It is indeed.
Mm-hmm. And so there are some people that are considering and have been making taxable gifts to the next generation that already were in taxable estates because of that low rate. And as we talk about the Biden plan later, obviously that's in question. The IRA conversion environment is really attractive right now. You may remember, and when we say conversion environment specifically, we're talking about conversions from qualified traditional type fundings to Roth funding. We're going to talk a little bit more about some of the differences around those, but fundamentally, a Roth is a little bit more preferential, or a lot more, when it comes to the next generation. We've got some changes that have transpired out there that are important. The old rules, if you made more than $100,000 a year in adjusted gross income, you could not convert from traditional to Roth IRA dollars. So it was kind of hard to get into this space. In 2010, that went away. And so now, especially with graduated rates, particularly if we have folks that maybe have losses this year because of the liberalized loss rules that have come out, this might potentially, and of course the pandemic, all these things, could be a good year to consider some of the conversion to a Roth. And then also, when you're looking at the multiple generations and effective tax rates and the new rules we're going to talk about under the Secure Act, it might make a lot of sense to consider conversion. So it's in the current state, that is something we really need to think about. So Ann, talk to us about how gift splitting works right now.
So gift splitting, you have the annual gifting amount, which currently is $15,000. It was it's a lot of you will remember when it was $10,000 kind of for a while there, and then it's been adjusting with inflation. $15,000 now since 2018. Gift splitting lets a spouse, husband and wife, gift up to $30,000 per person. You do need to file a gift tax return, which is called a 709. To document the fact that you're gift splitting. So if both spouses, obviously if both spouses are gift splitting, then both spouses have to file gift tax return. But again, gives us up to $30,000 per recipient. Does not have to be related. It can be really to anyone that they want to do gifting. The other place where we really like to use this is sometimes when we are, again, in a taxable estate, we're going to do anything we can do where we're gifting more than effectively what the discounted value is on our gift tax return. So we might need some valuations, but $30,000 a year per person.
Yep. Absolutely.
You can do a lot with $30,000 a year.
You can do a lot with
$30,000.
$30,000.
Yeah.
Especially by the time you get grandchildren involved
Yeah.
and multiple generations, and that kind of leads into this next
Yes.
concept, Mr. Coomer.
Yeah, Ann mentioned the $15,000 per $30,000 joint gifting. When one is gifting into a trust for one's beneficiaries, we still have the $15,000 annual gift exclusion, both for each spouse, for $30,000. What's often overlooked is, and I think the best way to explain this is with a quick example. Let's say there is a mom and dad, and they've created a trust for, or mom or a dad created a trust for their two children. The two children are the primary beneficiaries. So as gifts are made to that trust for those two children, we tend to think of, if it's a mom and dad funding the trust, $30,000 for each of the two beneficiaries going into that trust each year. However, if that trust is drafted to where the grandchildren may be contingent beneficiaries, they're not named as immediate beneficiaries in that trust. However, if the trust were to say, if one of my children predeceases me or does not survive me for, say, 120 days, then the grandchildren step up into that slot and can take that beneficiary benefit out of the trust. There is a case called the Cristofani case that was went to court in 1991, and the court said even though they are potential beneficiaries and their only interest in the trust is potentially taking out under the crummy rule the $15,000 or $30,000 gift within, say, 30 days or so after the gift is made. that's still, they rise to the level of a potential contingent beneficiary, so you get to multiply for each grandchild another $15,000 or $30,000, which means you can really fund that trust with a lot more money, even if the grandchildren will never take anything from the trust. Gets a little complicated, but stop and think about it. Talk to your CPA. They know about this stuff.
That's right.
And get that benefit of the larger contribution to the trust.
And it makes a big difference because
Big
ultimately,
difference.
one, you are able, because it stays inside that trust, you can control in the future, other than, you know, you got this period of withdrawal, but usually if the child decides to withdraw, things change really fast for the next year.
Change really fast. That's right. Don't make it next time.
And then these multiple abilities, and then once that money's inside that trust, you load up multiple exemptions, which is really nice. So you can put more money into that trust, estate tax / gift tax free, and then you have control over, according to that trust document, how those funds will be used after that right of withdrawal has expired. So that's it's very attractive, and you can put a lot of money in. Mr. Coomer, you're doing this right now with the clients.
Yes, we are. Yes, we are. Several. And, you know, we might mention quickly, we talk about a crummy letter or the crummy case, and it's not that it was a crummy case. It was Dr. Crummy, I guess, who's that the case is named after. To be able to use the annual exemption does have to be a gift of a present interest. And the way we accomplish that is, we've all done this, is we make the gift to the trust, and then we tell those beneficiaries, you've got 30 days. You can come and get this money out if you like. If you don't come and get it in 30 days or some similar period of time or rule, then it stays in the trust. And so that was based on a case for a taxpayer named Crummy. That's why it's called a Crummy letter. But that secures the present interest gift, and thus we get to use the annual exclusion against that gift.
Absolutely. And then the last point, we briefly touched on this earlier, portability. The conceptual framework here is if, you know, out of that $11+ million, if you're a married couple and one of the spouses dies, and say they only used $5 million of it, well, the other 6 and some change in that example would port automatically to the other spouse, which then can be carried forward. And so portability is a newer concept. Didn't come around until 2012. Is that the first year of portability? Somewhere around in there, after the fiscal cliff, if I remember right. And so it's an important concept.
Have to file a 706 though. Really important. The death tax return is due 9 months from the date of death. You can get a year extension, but that is your one bite at the apple to elect this portability. There's some really general loose language around what's required to report on the return. It's a much lower threshold in terms of valuations. So in theory, it's supposed to be an easier return to prepare. I don't know if you've experienced that. To me, I'm still doing about the same amount of work, even if I'm rounding off the numbers. We still have to find some basis for our valuation on these returns. But once we've made that portability election, then you've effectively preserved the deceased spouse's right to have up to whatever the exclusion amount was on the date of death. We'll probably get into this later, but another trick to think about on that is you can toggle whether or not to allow the surviving spouse to make a Q-tip election. I know for a lot of my clients it might be a second marriage or not, but sometimes different spouses have different plans. One spouse maybe wants to leave more to the child that's running the business. The other spouse says, no, I want to treat everything equal. So their plans are not necessarily mirror images. So you can still preserve the right of the decedent to have a different type of estate plan in the trust, but it says take care of my spouse while my spouse is living. And then again, for that to work in terms of portability is the surviving spouse makes what's called a Q-tip election, which then if we preserve the step up in basis, it lets us not have to just do these I love you wills that we used to do way back in the beginning where we say everything to my spouse. Right. So it lets us keep some parameters on the plan, but also preserve our ability to do step up in basis and most importantly, retain this portability, right?
Yep. And creditor protection.
And we could talk for hours about what a Q-tip trust is, but the idea is it preserves just what you said.
That's right. Just remember that term. If you think that you still want to trust after the first spouse's death, we can talk about it further, or your attorney, estate planning attorney can help you with that.
Absolutely. And we're going to kind of just briefly go over all these points that you're seeing on the screen right here in front of you. From a historical perspective, you know, we are really in a very nice season. We've talked earlier about the differential in AFRs. We talked about being really low rates from a 40% perspective versus some of the historical rates. And that is not just for estate tax, gift tax, but for income tax as well. I mean, Mr. Coomer, we were talking about this earlier. 37%, even though it feels like a lot of money sometimes when you're writing those checks, we got the 3.8 surtax on top of that. Share what we were talking about earlier.
Yes. This is a shock to a lot of people. You know, I hear people say, and we all complain about paying taxes. That's
right.
Part of our constitutional right, complain about paying taxes.
You know.
We have the right to complain about taxes. With a max tax rate today of some 37%, seems like a lot of money to pay on tax. But when I first started practicing public accounting, if one's income reached $400,000 on a joint return, the tax rate was 91%. 91%. And during the war years with the excess profits tax and a whole bunch of stuff like that, it got up 93, 94, 95%.
That's right.
But even in 1961, we still had a maximum tax rate of 91%.
Yep. It's
a lot of tax.
And just even on regular earnings, you had 70%, and that, you know, with basically the passive earnings or what, they weren't even passive at that time.
We didn't, and that term didn't exist at that time. It was just flat 91% if taxable income passed $400,000. It dropped to 70% in 1973.
Yeah,
which was a big adjustment. Big adjustment.
Huge. And then it still lived in 70 until tax act in 1986 or so.
That's right. Yeah.
And so, you know, even though it feels like a lot of money right now, in reality, it is a lot less than what we have seen historically. A lot less. You know, those huge, massive rates that were out there is why we have the Rockefeller Foundation, we have the Carnegie Foundation, these great, you know, organizations, because these folks were like, well, you know, I can give away the money and basically, you know, get a 94% different or 91, you know, whatever the number was at a particular time. And it's definitely promoted a lot of charitable intent. And so today, whereas on the other hand, you keep that dollar, your cost to keep the dollar is a lot less. And so that actually plays in a little bit, especially around this step up in basis, capital gains, et cetera, which we're going to talk about a little bit later.
Roth conversions.
Yep, Roth conversions, all that stuff kind of comes together.
Right.
And so it's a nice season. And we know that, you know, barring changes at the congressional level and the presidential level, that would result in a change in plan, we have this until 2026, at which point we reset, correct? And that's, Mr. Coomer was saying it's $5 million as adjusted for inflation, and that number in 2026 would be?
Well, today would be roughly $6 million.
Just
if we lost that, we'd go back to roughly $6 million today.
And because I do want to keep us moving a little bit here, we're going to brush quickly over the Secure and CARES Act implications. Because these were two big acts. The CURE Act, a lot of people don't realize, came out last year at the end of the year, and it changed rules around both RMDs and inherited IRA. So, Mr. Coomer, RMDs, maybe just give us a quick understanding of how that works.
Yes. This rule had been, the year that one reaches 7.5, you had to start taking money out of your IRA. Those were called required minimum distributions. Under the CARES Act or Secure Act, that has now been moved up to age 72. And the nice part for this year, we got to buy. We don't have to take it out.
That's right.
Those of us who are in that age group that have to take it out.
That's right.
So we don't have to take it out for the current year, and it moves up to age 72. So that's a good thing.
Yep, just interesting, you know, development that transpired, and in addition to that 72, you know, 50% penalty for failing to do that.
Oh, yes. Failure to take your RMD, it costs an additional 50%, which is pretty healthy penalty.
It is. It's a lot. And so, you know, even though that was a revenue sort of releaser, because that pushed that income off. So what happens in reconciliation, which is how all these bills get passed these days in Congress, they're looking for revenue raisers. And so the revenue raiser, Ann, is changing how, with inherited IRAs, how these work. And we used to have the old stretch rules.
Right. So new rule is 10 years. You have to take it out within 10 years from date of death. And we have some exceptions for surviving spouse,
Mhm.
disabled children. Y'all are going to have to
Yeah.
help me here.
Minor
10 years.
children.
Minor children up until they
hit
turn
age,
18.
Then it's back
Gap
to
of 10 years, isn't it? If someone's less than 10 years, and then
differential in age.
I'm missing
Yeah.
one. But so there are a few exceptions, but basically the change is now you have to take it out over 10 years, which for those of you that were using these accumulation and conduit trusts in your estate planning documents, probably going to need to go back and rethink some of those plans. The reality is they're still not awful. I mean, you have up to 10 years to take the funds out at the end. So there is still some control over how the assets get distributed out of the retirement plans. But it is going to obviously cause recognition of income much sooner than we previously anticipated under the old plan, which could particularly be onerous for our people that have children that are possibly in their highest income earning years.
Mhm.
So it's kind of a double whammy that we're layering it on top of perhaps an already higher income tax bracket for the beneficiaries. Some people are recommending that you look at your documents and change them from the conduit trust, which used to say all the R&D goes to the beneficiary,
Mhm.
into an accumulation trust.
That's right.
However, what that's going to do is cause the trust itself, which now is the owner of the assets, therefore the payer of the income tax, is going to hit those maximum tax brackets much faster than individuals. It's a little over 12,000
Right.
when you hit the maximum tax bracket. So you run a few of those returns and look at the difference, and it is noticeable.
It is noticeable,
It's kind of a
graduated rates are actually attractive.
Yes, the graduated rates make a big difference on individual income tax returns. So as you recall, what we used to do is be able to pass the income out to the beneficiaries, and then they're able to take it at their potentially reduced tax bracket. So if you have a situation again where you want to stretch it out over the 10 years, we're now accumulating income inside the trust, not passing all the income out every year. Therefore, we're hitting those tax brackets, those maximum tax brackets, much faster.
And one concept that's out there around this new development, which is a pretty significant one, is potentially using CRTs to help kind of work around some of the rules. Because the CRT allows you...
Don't talk in code.
Okay, sorry, charitable remainder trust. It can be either a charitable remainder annuity trust or
Yes.
a charitable remainder unit trust, which just determines how that payment's going to transpire. Thank you, Ann. Which is basically to say, if we leave these qualified plan assets to a charitable remainder trust, then as that money gets paid out to the trust, that money begins to accumulate inside the charitable remainder trust. But then there's an annuity payment or a unit trust payment of a percentage or a set dollar amount that then is paid out to the beneficiaries, which could be your children, grandchildren, et cetera. And so what happens is now you have the ability to control that stream. So particularly, instead of just maybe Jimmy doesn't make the best decisions all the time, instead of leaving the IRA directly to Jimmy where he could get instantaneous access to the entire funds, you could put it into the CRT. Obviously, you want to have a charitable inclination because in theory, if Jimmy did pass away early, he would only get that stream for as long as he's alive.
Right.
And then the residual, the remainder interest, would pass to the charity. And so there's some ideas out here where you can still kind of mix and match, and they only pay tax. The tax is only paid at that point by Jimmy as he receives those funds. You've got this wonderful concept called WIFO, first in, first out, that lives in these CRT worlds. So all this is fun stuff that we like to talk about and theorize on, but it's real. We file quite a few of these each year, don't we? And so just lastly here, really want to talk about making sure that when you have these funds, especially now that they're having to come out faster, that are qualified and carry these ordinary income rates, consider integrating these into our charitable causes, because when charities receive these funds, they don't pay taxes on it, which is a really nice concept. And then lastly, in the CARES Act, and this was a pretty big deal, we had some changes to the normal new 60% rule that we have. So we have multiple percentages of AGI that are required to be studied when it comes to the deductibility of charitable contributions. So the CARES Act liberalized, didn't it? And so we have some new rules around this new 100% concept for 2020. And you want to talk about that for a minute?
Yeah, so what this lets us do is if those of you that recall in the past, you would make charitable gifts and it was limited but to 60% of your adjusted gross income, we got to carry that forward, but eventually that expired. So this newer provision now lets us give up to 100%, but it does have some restrictions. So we can give 100% of our adjusted gross income, but it has to be cash, and it has to be to a public charity. So the thing that we're really, that we've been talking to a lot of clients about over the last couple of years are these donor advised funds. They were a nice tool to help us bunch our annual deductions so that we're doing our property taxes, our charitable giving, our elective surgery, I guess. What else, DJ? Our charitable gifting, I guess,
absolutely.
if we can bunch some of those into one year and then take a year
Double
off.
up on your, property tax situations, all
Right.
those different things. Can't prepay. There's all those different rules.
So we really like donor advised funds for those bunching techniques, but unfortunately that's not going to work for our 100% charity. So do you want to talk about really what we're saying? If you're going to give cash, then it's a benefit, but
we don't like to give away cash. For all of our high net worth clients, this is on the income tax side, but this also plays into the estate and gift as well. The assets that we want to give to charities are appreciated assets. So think about that Apple stock that you bought for, $50 before it went, up to 700 and did a 10-for-1 split, and then just did another split this last year, and so that has a super duper low base, which is to say, if you give away that, get the deduction at fair market value. Now, you don't get the 100% of AGI rule. Instead, you end up, depending on the charity, whether it's a private foundation or a public charity, you end up with either 30 or 20% of AGI. But that's the type of asset that we want to give away because you get a double benefit. You get the fair market value from a deduction standpoint for income taxes, but you also don't have to pay that capital gains tax. Whereas if we give away cash, which is a nice thing that the CARES Act allows here to get this 100% of AGI deduction, but it's cash, and that basis is equal to the fair market value. And as we talked about earlier, especially when it comes to planning around step up in basis, those are the types of assets that we don't like to give away. And if you think about it, that's if you would turn around, now you're having to pay tax in order to liquidate funds for living expenses, et cetera, because you realized gains on this appreciated asset. And so, we don't want to, we always want to give away. If you walk away from today on the income tax side, I would think always give away appreciated assets.
Absolutely.
So normal strategies. So we're going to spend about the next 5 to 10 minutes talking about kind of some baseline concepts in the estate and gift tax world that help us deal with estate tax. And these are important because when we talk about the Biden plan in a moment and then talk about, some responses to that, these concepts could potentially have a shelf life. And so what we want to talk about is just the normal process that we work through. And so we've got 3 kind of main headers here, which is the estate gifting strategies to stay below or minimize estate tax, and then plans for protecting step up in basis, and then of course for tax funding for actual when we're going to end up paying some estate tax out there. And so these estate gifting strategies. So we've started talking a little bit about basis shifting, getting things outside the estate. So the traditional planning is how do we get appreciating assets outside of the estate so that they continue to grow outside of the estate. And our conundrum has been over the last couple of years with these great, big, huge exemption amounts as well. Which assets do I want to leave in? And then this gets into swapping. So, Ann, why don't you kind of tee that up for us? And then, Mr. Coomer, why don't you kind of share a little bit about some of these swapping and how we would plan for what might transpire in the future?
So the concept of swapping is that, this may be a familiar term to some of you, grantor trust. So what we like to do is set up grantor trust, which means you have taken it out of your estate for estate tax purposes, but it is still taxable to you for income tax purposes. And now all of you out there saying, why do I want to pay income taxes on income I'm not receiving? Well, we used to call it the tax on the tax. But the concept is if you are now in an estate tax, your assets are now at the point where your estate will be subject to estate tax. if you pay $1 in income tax now, but you didn't get the income tax, then effectively that's $1 that's not going to be subject to estate tax at your death. So you're passing the income on to the next generation, not paying the next generation's not paying the income tax. So it's growing effectively tax-free. However, what we're finding is that if we're putting these large appreciated assets inside the trust, what we're missing out on is a step up in basis that as of this point we still have. So one of the tools that we build into our trust agreements are swap powers, which say the grantor can move assets in and out of the trust and swap them for other assets of equal value. So our old plan was we would put in our Apple stock, to use CJ's example. It's appreciated now over 10 years. We get to the end of the 10-year period. We swap out cash today for that Apple stock. Now I've taken out that low basis asset outside of the trust. I've kept the value equal between the two, so there's no gift. And now if I hold that Apple stock at my death, I get the step up in basis. So it's a win-win.
That's exactly right. And Mr. Coomer, sometimes we come up with these plans and then we, put them on the shelf and we forget about them.
Yeah.
Yeah, that's.
Do we do that? Do we ever do that?
Well, I was going to say that's the norm. That's the norm. What trust? Yeah. Did I create a trust? Yeah, we do. Let me back up just one second.
Yeah.
And what you're saying is all something I think we don't think quite in those complex terms sometimes of swapping one asset for another. So that's something to be aware of. However, even going back to something even more basic than that, if we're talking about making gifts into a trust for the next generation or whatever, let's think in terms of something as simple as let's put an asset in that trust that will grow in value and get outside my estate, rather than taking the cash that I might use to put in that trust. And as you said earlier, that's dollar for dollar basis. I'm giving away something that's worth $1 and it's going to be worth $1 when it gets over there, unless it's reduced by tax. So if I can put that Apple stock in there, and even before I live long enough to do the swap, if I die, then at least that increased value of 700 times or whatever.
That's right.
Is not taxed in my estate. So
That's exactly right, Mr. Coomer.
kind of simplistic, but that's kind of where I start when we talk about that kind of thing.
Which is to say, if someone had $10 million today, and we've done just a litany of different plans around these concepts, the numbers are getting bigger. So now when we're doing estate tax planning, it's a little bit of a different exercise. But we used to do this literally for every client. I mean, when I came back to Blankenship CPA Group, moved back here to Nashville, we were still doing estate planning for pretty much every single client. Between, I think it had just gone from 600 to $1 million for a federal, and Tennessee was still, I think, around 600,000.
That's right.
And so you were doing state versus federal planning and integration, all these things. But just take, for example, this roughly $10 million example. Somebody has $5 million cash, and then they have $5 million of Apple stock, and they just bought both of them, right? The cash is sitting. So they had $10 million cash. They took $5 million. They bought Apple stock. Well, the asset that we want to gift at that point in time, in just all things being equal perspective, into that estate, into that trust that's moving it outside of our estate, our exemption goes down by $5 million. We have $5 million left in the future. Isn't the cash? We want to move the appreciating asset, and that is always the concept. And so, because next year, when the cash is still $5 million, and we spent some on it, right? And Apple stock has gone from 5 to 6 or 7 or whatever that number is. That growth, that delta, that difference has been transferred outside of the estate, estate tax free. And so that is really important. The integration with the step up in basis is what Ann was talking about, where we can swap these assets.
Exactly. And
turn around and say, well, actually, I'm going to take $7 million of cash, swap it for the $7 million of Apple stock now that it's grown over the last little bit. And now that next generation has something that doesn't have that $2 million potential gain in it, which that next generation, because of carryover basis concepts, would have to pay tax on. And so these types of concepts, the idea is let's get these assets that are growing outside the estate, but still have the flexibility to be able to plan for the step up in basis. while it continues to exist. And
I think that's a really important point. We don't necessarily have it on our sheet, but the thing we are alluding to, but we really haven't just spelled out, I don't think, is that when you make a gift while you're living, it gets carryover basis.
that's right.
Which is huge in terms of long-term planning. So using CJ's example, that Apple stock doesn't have the basis of $7 million on the date of death of the decedent.
Right.
Its basis is the $5 million, which is the carryover basis that the person that put it in, the basis to the contributor to the grantor. And that's where a lot of our play comes in terms of our planning. In the old days, as CJ's pointing out, all of our planning was around getting out appreciation out of the estate, because so many of us were going to be subject to estate tax, just considering life insurance, equity in your home,
house.
and
Yeah.
your 401k.
That's
Everybody had to do estate planning. But now that we have our whole concept of step up in basis and our higher exemption amount,
For now.
it's really changed our planning. And, you know, we're looking at a situation now where we're trying to anticipate, or do we want to keep our step up in basis planning that we've really been slowly but surely building into all our plans?
That's right.
Or are we going to need to go back to our pulling out the appreciation out of our estates?
Yep.
And I recognize that all of you sitting there saying, so what's the answer? We're all saying, so what's the answer?
So what's the
Yeah,
answer?
that's right.
Unfortunately, it's a really unique time in
Unique
history
time.
where we're trying to anticipate the outcome. And I guess the thing that I like to remind a lot of my clients is what's going to happen in November or in 2021 is not necessarily what's going to be in place when you pass away.
That's exactly right.
So we need
That's
to
right.
still big flexibility into our plans, and that's the hardest thing.
And flexibility is one of the key concepts that really has to be baked into every plan these days. We need flexibility around playing with appreciated assets versus high basis assets because of the step up in basis concept. Oftentimes people need flexibility around access to funds.
That's right.
Most of the time when someone has worked really hard over the course of their career and you start talking to them about gifting these assets into irrevocable trust to get them outside of their estate, the first thing they say is, well, what if I need the money? And it doesn't matter if that person has $5 million or $50 million or a couple $100 million. That usually is the very first question is, well,
That's right.
what if I need the money? And so that's where certain, especially this year, with the things we're going to talk about here in just a couple moments on Brown Biden, it is really important to build flexibility into plans. And so, you know, we've talked a little bit about integrating the step up in basis with the gift tax, the substitutive rights, these kind of concepts. One other thing, I want to talk about two things very quickly on the slide, and we need to get to the Biden plan. But discounts, and then I want to talk about the ILA, because these are two issues that I think are missed quite often. Mr. Coomer, when we sell, or gift, I should say, an asset, or if we sell it with some of our advanced planning, doing estate freezes, things like that, we like discounts, don't we?
Yes, we do like discounts. Yeah, and the concept of gifting an asset away at a discount has to do with, you know, there is an appraised value of an asset. Cash seeks its own level, for example. Other assets will have a value based on appraisal attributes or what someone thinks an opinion is. But if I'm giving away an asset, for example, let's say that I own a few shares of stock in a company. I'm a minority shareholder. If I'm going to give, and I see that those shares of stock have growth potential, could be a family-owned business or a small business like that. But if I'm going to give away my interest in that business into a trust for the benefit of my children, since I own perhaps a minority interest, or even if I own a controlling interest and there's no market for that stock, then it is discounted back based on those attributes that are used in valuation, art, and science now, so that my gift may be, in my hands, that asset may be worth $500,000. But there may be significant discounts due to market of likability, the element of control, and all of those things that are enumerated in that Reverend Rule 5960 that Internal Revenue Service put out in 1959, that for gift tax purposes or gifting purposes, that asset may be worth a lot less than that $500,000. So that's what I want to do, is take those discounts give it away at a minimum value to me, maximum value to the beneficiary.
And those discounts can be pretty significant at times, depending on the
Discounts
underlying
are.
assets. And so that's another thing. If you can turn around and you can't just package up the asset at a family limited partnership. There needs to be substance, not just form.
There has to be.
There has to be substance. But when we can plan for and appropriately document realistic and reasonable discounts, all of a sudden we're giving away $1 million asset for $650,000. So that differential in the discount, just like an appreciation, is instantly outside of the estate. Once we file that gift tax return, it'll be 3 years.
That's right. Instantly outside of 3 years. That's right.
And attach the valuation work to it.
Yeah.
So,
Right.
and then just the last concept here, and I'm actually just going to briefly talk about this. If we have life insurance, please, please, please revisit that life insurance structure, because I cannot tell you, I mean, this year alone, probably just in the last 2 months, I think I've had 3 or 4 conversations with people about their life insurance where it was creating a taxable event for them, because they had gotten these life insurance policies that had been the beneficiary, either themselves or the estate, and even in buy-sell situations. Sometimes you'll see these life insurance policies that are out here that are not in through an ILET type structure, which means that the instantaneous funding, instead of having the opportunity to, you and a partner each own a $20 million company, you each have a $10 million policy. Instead of having that $10 million policy in an ILET in conjunction with a buy-sell agreement, it's either owned by the company or it's just owned individually by that person, which means when that life insurance funds, all that value stays inside the surviving partner's estate. Whereas if you can use an ILET in cross buy-sells, one, the ILET itself is a complete gift, right, as long as you function correctly with this. And then now this ILET owns the other portion of the company, and that other $10 million is staying outside of the estate. So I've literally this week had a conversation about that.
Well, then back to the code. ILET stands for irrevocable.
I'm sorry.
Life Insurance Trust.
I'm so sorry. Speaking in code again, I'm in trouble. Thank you guys, absolutely. But just planning around life insurance is really significant. And also with the COLI issue, there's really big rules. I mean, that can become taxable if you don't fill out the appropriate paperwork on the tax return for the entity every year. So this is a big deal. So this slide right here, it's wild to look at.
That's why you're all here.
That's why we're here. Here's the end of the meeting. And but the Biden plan, this is the outline of the Biden plan that we're looking at here. And if you read through these, it's almost like, is this all going to really happen? So just as a preface, let's just even go back to the promise of the repeal of the Affordable Care Act that was out there. We still have the Affordable Care Act.
Yeah, we do.
Going to the Supreme Court right now. There's some other things that are going on around that with the stripping out of the individual mandate. But generally speaking, that was the promise 4 years ago. We're going to repeal the ACA is what all the Republicans were saying. Well, they didn't do it. They were not able to make that happen. And it was because even though they had the House, the Senate, and the White House for 2 years, prior to the House flipping back to the Democrats 2 years ago, they had a lot of infighting, and they couldn't get it done. And I think it came down to 1 or 2 votes, and multiple times. It was a big deal. And so, first of all, you've got to have a line.
Which
and then you
I
also
will just say, some of that comforts me, right?
Yeah,
the separation of powers,
it,
sometimes it works,
yeah. And
right?
so really, it is. And so for the Biden plan is laid out here to have realistic chances of going through in its entirety. You're going to really need to see in the election pretty much everything align on the Democratic side of it. And then you still have potential infighting. So then the question becomes, how narrow are the margins?
And they attempted to do it. I mean, the getting rid of the step up and base system, they attempted to do it before, and they didn't get it through. So again, separation of powers is a comfort.
That's exactly
right.
And so
protection.
So these types of concepts most likely transpire if you see a complete shift of all branches to the Democrats. And if that transpires, there is a chance that we could see at least some of, I would say, we will see some of these things.
Some.
The question is how much and to what degree. But there is a resounding support around all of these points right now in the Democratic caucus. And so what they're proposing is higher income and estate tax rates. So both the 40% estate tax and then that 37% income tax, both of those would go up. Lower estate and gift exemption So this is, they're proposing 3.5 million. Instead, they're wanting to undo all of the Tax Cuts and Jobs Act that was passed in 2017. Corporate income taxes are going up as well. I think 27 or 29%.
Yeah.
Which one was
27.
it? 27. And so repealing TCJA, this increasing the capital gains tax, pretty big deal. They're wanting to beef that up. But then most importantly, for anybody with an AGI over $1 million, no capital gains tax is the current proposal.
Mm-hmm.
And I mentioned earlier the, estate exemption, 3.5 million instead of the 11, and not even letting it get to the readjustment in 2026. And now this is the biggest one, and you shared a great story about this, but this is the baseline of the entire Biden plan, is the removal of the step-up in basis.
The removal of the step-up in basis, as we talked about briefly a while ago, that is major. And just the bureaucratic complications of making the plan work. We're talking about additional cost to the taxpayers, confusion, loss of care of a basis, increased taxes. That's the biggie to me.
Yep.
That's the biggie.
And another overlay is they may make recognition of tax effective on date of death.
That's
So
right.
not only do we get carryover basis, not step-up in basis, we have to pay tax at the time the person passes away. You can't hold the family farm without paying tax.
And that is
it's just onerous. I mean, it's
Yep. I mean, and that is on both death and gifting in the current Biden plan, which is to
That's
say,
right.
if you had $1 million family farm or $1 million house, great example. You paid $1 million for this house, it's appreciated to $2 million. Upon death, you would pay tax on that $1 million of appreciation.
Mm-hmm.
And then also, come back to the Apple stock example. You paid $100,000 from Apple stock that's worth $1 million today, and you wanted to gift that. So not only on the estate side, but also on the gifting side, you would actually pay tax on the delta between the $100,000 and the $1 million fair market value at the time of the gift.
And the natural result is the asset gets sold.
That's exactly right. Because you
Breaks
do
up the
not
wealth.
have the liquidity.
That's right.
And what it does is it inhibits our
Income
ability
generator.
to pass wealth to the next
Yeah.
generation effectively.
It
I mean,
really
it's
is.
really what it does. It puts money into the government's hands faster.
an
Wealth
income
redistribution.
generator.
And
It is.
absolutely. And we were talking earlier about some of these concepts. Like, this sounds crazy to us as good red-blooded Americans. This is unconstitutional in its very core, and this is just foreign concept. But it's not a foreign concept to foreign powers, is it, Mr.
No, it is not. In fact, you corrected what I said a while ago. I said it's the Canadian approach to this, and as you mentioned, it's also done in Europe, and I was not aware of that.
Yep. Canadian approach, the Scandinavian
That's just
countries.
next door.
Yeah, it's not very far away, and this
Next
is
door.
the way it works. And is that you pay tax at the time of gift and or at the time of death, and it's and or in many of these countries. But then the last thing that's in the Biden plan as well is a potential deunification of the credit. There's not a lot of people talking about this one, but it's been mentioned, which is to bring down the gift dollar amount. We've had this unified credit, and this is the way it used to be. We didn't always have unified credit. So the gift, the amount you can pass during your lifetime, is not the same under a deunified system as the amount you can pass upon death. And so this plays into the ability to be able to gift in the current time. And so, well, what do? We've got a client event that is scheduled November. The email will be coming out here in the next couple weeks, but
12th,
17th,
maybe?
12th,
12th,
yeah, right
maybe?
before the 15th
12th.
deadline. So after the election. So who knows if we'll know the results, right? But that was the intention when we started working on this. And we're going to get a lot more in depth into, okay, what do we do now? So we hopefully have at least an idea of how things are shaping up. But a couple of planning considerations here. We're going to go about 5 minutes over, I think, right now. But I do want to just talk about a couple of these planning considerations in light of the Biden plan, because some of these things, if appropriately structured, are healthy decisions no matter what. And that's really the key, I think, is we look at, well, what is going to happen? So twofold. One, estate planners are going to be really busy. And this is something that's important to understand. If all of a sudden there's a complete shifting of all branches to the Democratic Party, and we have the background of this very, well-touted Biden plan that's out there, high net worth individuals are going to be running to their estate planners.
Yes, sir.
And the estate planners, much like what happened with the fiscal cliff, they will not be able to do everything. And so we had a lot of folks that are already doing some background work. Next Friday, I'm meeting with estate planning, one of our clients, with their attorney to do two things. One, to move some assets because we had some substitutive rights, stuck it on the shelf. All of a sudden now I've got this highly appreciated asset from the fiscal cliff that's sitting out here that's worth, that's probably 20 or 30 times what it was when we put it in there. We're going to swap that for some cash. But then also we're going to visit some of these strategies because you want to come in and get some of these things kind of built up and ready to pull off the shelf and fund right now over the next month or so, month and a half, before there's a run on the bank, so to speak, if it was to transpire. But even as you're doing that, you want to do it with flexibility in mind. Part of the overall estate plan, it's still good hygiene type. These aren't just, oh my goodness, freaking out and I'm going to just do whatever I can, which is what we saw some of at the fiscal cliff. Give away everything I possibly can, take advantage of the exemption. We don't know what it's going to look like. And then now all of a sudden we look forward, we've got $22, $23 million of exemption that's out there. But if these move backwards, and now you're looking at a $3.5 million exemption or a $7 million exemption for married filing or married couples, or we're looking at higher capital gains rates, or we're looking at a removal of the step-up in basis. What we want to think about is using up that exemption now, right? And having the ability to be able to take advantage of the current gift tax regime. And so there's a lot of different ways to do that. So we've got a list here of kind of estate freeze type concepts. So this is where we, in essence, we freeze the estate. There's a lot of different ways we can do that, right, Mr. Finley?
Absolutely, yeah. Estate freezes at one time was a dirty word, but we better be thinking in terms of estate freeze and the ability to swap assets and what's known as an intentionally defective grantor trust. If a person has the wealth, the assets to do it with, is a great way to freeze that estate where it is at the time you dispose of it. Mm-hmm. And that's what you referred to a while ago, with swapping of assets.
That's right. And sometimes we might find ourselves selling assets, which keeps the current value in the estate or some portion of it, and taking a note back, especially with these really great AFRs that we talked about earlier, these super low applicable federal rates.
And that's a non-taxable sale.
Non-taxable.
That's right. No tax on that sale.
That's right, because the IDGIT, the Intentionally Defective Grantor Trust, don't use the acronym, CJ, is disregarded for federal income tax purposes. Right. And so, in essence, a really great strategy that's out there. The GRATs right now are a good strategy to potential. This is a healthy thing to do no matter what, especially if you're in a taxable state or going to be in a taxable state situation. Mr. Coomer, we talked about these GRATs earlier. They make a lot of sense potentially right now.
Especially with the low rates.
Mm-hmm.
You can move those assets out there and set that annuity at a very low rate. Let that growth grow.
That's
just
exactly.
move it on down the road.
That's right. And then, Ann, I think that, this could be the year, the greatest year ever for the SLAT, is what I'm thinking is how this sets up. Can you just tell us a little bit about what a SLAT is?
So a SLAT is where two spouses set up effectively mirror trusts, although they're really not mirror trusts.
And they can't be mirror trusts.
Yes. So you have to build in some little provision that makes the terms different. Maybe you put what we call a 5 and 5 power. Again, we're talking code. But you draft in some provisions that are different between the two spouses, but effectively spouse number 1 makes an irrevocable gift to spouse number 2. Spouse number 2 makes an irrevocable gift to spouse number 1. And we have both frozen as assets and protected them from creditors, if I'm right, CJ, right?
Right.
We get that creditor protection. Mm-hmm. And what we like about these, though, is if we don't like it, what we affectionately call, we blow it up at the end. So we've built in flexibility in the extent that we can either distribute 100% of the assets out to the spouse, or we operate one of our other provisions that's inside the trust, like we intentionally have one of our team members, we call them trust protectors, they decide to terminate the trust. That's another great tool that we haven't really talked about here, but a great provision for flexibility that's really only come into favor in the last 10 years. I don't know, it was kind of an offshore trust concept that's now integrated into a lot of our trust language. We name a third party that has some rights that we can't retain as the grantor, and one of the things they can do is effectively terminate the trust. So we've made an irrevocable gift, we've transferred out the assets, we've built in provisions that allow us to protect from creditors, and we still have retained the flexibility to be able to dissolve it if we need to.
And again, the acronym SLAT stands for Spousal Limited Access Trust, or
Right.
Spousal Limited something other trust.
That's
It's a
right.
couple words.
That's exactly right. Yeah, another acronym.
Another acronym.
Hey, that's why we put acronyms in the slide deck, so you'd have to watch. And, but I think this could be a really nice year for that, because we can do some of the funding and some of these completed gift type concepts, get these assets out. But then if things don't end up going the way, either Congress is dysfunctional, not that Congress would ever be dysfunctional, right? And things don't transpire as anticipated. And keep in mind, we still have the sunset that's coming in 2026 as well, which is a big deal.
Still out there.
Right.
And which is, pulling it back to that $6 million we talked about earlier as adjusted for inflation. And so there's a lot of, the SLAP can make a lot of sense. And if things change, I love the flexibility to be able to, as we say, blow it up and bring it all back in and start over again, which is really nice.
Really, another way to think of it is it's really almost the same thing that we all have been doing for years and years and years, which is we built these trusts in for our spouses, right? And what did they do? They gave us creditor protection, they froze the assets, they took them out of the estate. So effectively, it's a lifetime spousal trust, just like what you would have built into your old estate planning documents, if that helps a little bit.
That's exactly right. And you integrate this with the overall plan. And so, charitable lead trusts potentially could make a lot of sense this year as well. We talked a little bit about those earlier. And then just kind of trying to wrap up, and we're going to get more in depth in November into some specific strategies. What we'll talk about is the top 10 things to do in light of the election results from an estate planning perspective. But 529 planning is a really great tool right now. We've had some liberalization under Tax Cuts and Jobs Act. We can use 529 assets. These are basically the college savings funds to be able to fund primary education as well, so private schools. Some great benefits for disabled children. I mean, just really, really special. Is it ABLE? Is that what it's?
ABLE.
Yep.
ABLE plans, yeah.
Which is really, really nice also. And then Roth conversions. We've been talking a lot about this, haven't we?
I'm just telling you, it's a really hard climate to not be thinking about Roth conversions, because if we're looking at increased income taxes, and we're looking at our stretch provisions that got just hammered under the Secure Act, this might be the time to bite the bullet and pay some tax. Now, all the numbers I'm seeing that are run, it really only makes sense to do it if you can pay the income tax without having to pay it out of the funds that you're converting.
That's correct.
And the other thing I'm telling people to look at is there you go, is look at what your brackets are and just convert the amount that's going to keep you from jumping into that next bracket, especially going over that 24%. That one, that's the painful one.
Yep.
So if you can try to take advantage of some graduated brackets, I know for a lot of people that are still generating income, that's not that doable, but as you start stepping back from work, maybe we start doing them as kind of these, we used to call them laddered grats. You're kind of doing the same thing. You're laddering your Roth conversions.
And taking advantage of those graduated rates. And that is really nice, because now you're not stuck as that money gets paid out to the next generation of 10-year rule underneath the Secure Act. As a Roth, so you don't get a deduction, you pay tax up front. It grows tax-free, and as it's paid out under appropriate circumstances, there's no income tax.
No tax.
And so in essence, what this is saying is, if you have these graduated rates, we're in a rising rate environment, it really could make a lot of sense to go ahead and pay that income tax if you can take it lower bracket, because you're going to have the R&Ds that Mr. Coomer talked about earlier, and then we're going to have the 10-year stretch rule. The old lifetime stretch is gone unless you're a spouse, right? Or other certain limited circumstances. But that money's going to have to come out a little faster than it used to. And so if we can make that money come out income tax free, and it can sit in there all the way until the end of that 10-year period and grow, that feels really good.
And we talked about this in our hygiene speech. TJ's really good at giving the hygiene speech, but really nice tool for children. if you've got children working in the company and you're setting them up and you're doing steps or whatever you're doing to help, you're paying them salary, they're doing real work. We always say that, doing real work. But then they're contributing to a retirement plan. Maybe the employer is contributing to set for the children. Go ahead and start doing these Roth conversions on an annual basis while they're in perhaps a zero income tax bracket.
Oh, and if you have a young child, 16-year-old that went to work over there at the Chick-fil-A in Brentwood, they're earning $5 or $6 or $7 grand a year. Take your money and put it in a Roth account for them. It is so fundamental and important to take advantage. We've got some examples from previous things we've done where it shows the power of, putting $5,000 or $6,000 a year into your 16-year-old's account until they get out of college. It is just, you see these numbers, it's mind-blowing. And
because it's under 15,000.
That's right.
The parent can make the contribution. That's just to reemphasize that. A lot of people don't really realize that they can make the contribution for the child. So the child still gets the reward of working and keeping the income, but then the parent makes the contribution.
That's exactly right.
Buying the tennis shoes.
That's right.
Whatever it is.
That's right.
That makes more sense than just giving the child $5,000 and saying don't work.
That's right. And they may or may not know about that Roth IRA.
They may not know about it. Exactly.
Well, great. And so I know we've gone over here on our time, but get the program moving now and revisit those plans and just these closing perspectives here. Make sure you've got a good plan. And it's been established with your advisors. We are more than willing to help. Consider getting these early documents prepared. We're going to have this meeting in November. Be on the lookout for our all-client invites. Look forward to having you join us. It'll be a nice time where we talk about the top 10 things to do from an estate and gift perspective as a result of the election. This will be kind of a 101 prerequisite, so we won't go back through all these baseline concepts that we really had to talk about before you can get into the Biden plan and what to do next. And so for the folks that end up watching this video, we're excited to hit you with the next points. But revisit these old plans, these swap provisions, et cetera. Not on here is these annual gifting strategies. You've got to make sure you've got a good annual gifting strategy. Don't be giving away cash every single year to your kids. I've seen so many examples of that. We don't like doing that. And make sure we got the right record keeping going on. Some of these different strategies that are out there require us to keep some trusts to the books. We need to make sure we're doing that. Take action now to protect our assets later. So important. Mr. Coomer, any closing thoughts?
Oh, that's it. Let's look ahead. Let's get this election behind us, then decide what to do.
That's exactly right. Ann?
Just to the extent we can help, I know that we're saying go back and look at your documents, and I know sometimes they're in Greek. Just like we talked in acronyms, I know that the entire document can feel that way. So if we can help even to decipher what your current plan is and then help you figure out what some good next steps would be to go back to your planners. We really work well with all of our planners in the community, so we know how to walk in and say, these are some things that we thought about. What are you thinking about? What can we do to help our client jointly? So we really enjoy working as a team with other members in the community, and I think the message is get your documents out, brush the dust off, and let's do some planning.
Absolutely, and it's a great season to do that, as always. And what a blessing it is to, we had a small group today. Looking forward to our client event, really doing some marketing around that. Thank you for being a part of the initial team here to get this recorded, to answer this chat question. Absolutely. So we will get this downloaded, recorded, and we'll stick it out on the website and send out, obviously for everybody who was on here, but then to the client base, so that prior to the actual client event, I think that there's going to be a lot of folks that will take a look at this, hopefully get a great baseline. Mr. Coomer, and I am so incredibly grateful for y'all taking the time to sit here and talk with our great clients and enjoy it. As a matter of fact, we'll sit on here as well if anybody wants to ask a question, but at this point, we'll kind of close out the presentation itself. But wonderful, wonderful to have such a amazing
fun.
mind.
Thank you.
Thank you so much for spending this time together.
Joy.
And thank you to everyone else. We're just so grateful to serve you. And if anybody wants to unmute themselves, feel free to, and we'll be sitting here here listening. Thanks. Have a great day.